How to avoid impermanent loss on crypto DEX. Have you ever wondered how to protect your investments while using decentralized exchanges? Today, we will discuss impermanent loss and how to minimize it when providing liquidity on these platforms. Impermanent loss happens when the value of the tokens you supply changes compared to just holding them. This can lead to potential losses when you withdraw your funds. So, how can you avoid this? Let's break it down. First, consider providing liquidity in stablecoin pools. Stablecoins are cryptocurrencies pegged to stable assets like the United States dollar. By using stablecoins such as USD Coin, Tether, or DAI, you can reduce impermanent loss since their prices ranges relatively constant. However, keep in mind that this strategy limits your profit potential during market rallies. Next, think about choosing low volatility or equivalent asset pairs. Providing liquidity for pairs with low price fluctuations, like Ethereum and wrapped Ethereum, can lower your risk. Avoid highly volatile pairs, as large price swings can increase impermanent loss. Monitoring market conditions and entering pools during low volatility can also help. Another option is to use pools with multiple assets or flexible ratios. Some decentralized exchanges allow you to provide liquidity for more than to assets or set token ratios other than 50-50. For example, balancer pools can have up to 8 tokens with custom weightings. Diversifying your assets and adjusting ratios can lessen the impact of any single token's price movement. You can also consider concentrated liquidity and trading range settings. Platforms like Uniswap version 3 enable liquidity providers to concentrate their funds within specific price ranges. This can increase your fee earnings while potentially reducing exposure to impermanent loss. However, it requires active management as prices change. Additionally, look for single-sided liquidity provision and insurance options. Certain protocols allow you to provide liquidity with just one token instead of a pair. Bancor, for instance, offers impermanent loss protection through an insurance pool funded by trading fees. This guarantees that liquidity providers can withdraw at least their initial token amounts. You can offset losses with trading fees and patience. The trading fees you earn from swaps in the pool can help compensate for impermanent loss over time, especially in high-volume pools. Waiting for price ratios to revert closer to your original deposit ratio before withdrawing can also mitigate losses, as impermanent loss is often temporary. Lastly, actively monitor and manage your positions. Use tools to track price changes and impermanent loss risk. If volatility spikes, consider withdrawing liquidity or adjusting your positions. Timing your entries and exits carefully can help reduce your exposure. In summary, avoiding impermanent loss on decentralized exchanges involves selecting stable or low volatility pairs, diversifying assets, using advanced pool features, leveraging insurance options, and being patient to allow trading fees to offset losses. Active management and understanding the specific mechanics of the decentralized exchange you use are essential to minimize impermanent loss while earning from liquidity provision.